In today's episode, we're speaking to Mark Myers. Mark served in the Marines for 8+ years and received the Distinguished Mette Award and Robert A. Mette Award for Outstanding Leadership. Today, he is a founder and the CEO of Peak Profit Solutions, a financial services company that for 15+ years has helped thousands of people, business owners especially, permanently reduce their tax bills on average of 50% without replacing the CPAs or financial investment advisors. And today we speak to him to find out how you can treat your tax as a profit center. How? Let's find out. Welcome. This is Gull, your money mindset expert. And today I'm so excited. Once again, we have the charming Mark Myers. Welcome, Mark.
Thank you, Gull. Thank you for having me.
Thank you so much for joining us again, Mark. We had a fantastic conversation on Friday Feature, but we had to have you back today on Money Talkies. Everyone's heard your intro once again, Mark. Please, but telling you what it is that you do.
I help people reduce their most consistent burden, which is tax liability. So I help them reduce that quite substantially.
Wonderful, because today we are talking about how to treat your tax burden as your profit center. Now that title is really interesting. Most people think, how can I possibly make my tax burden into a profit center? How do you do that? Well, surely I have to pay my tax. So do you want to explain the title first?
Absolutely. Most people, particularly if they're business owners, but they don't have to be business owners. I can help non-business owners. They look at that tax burden, that check that they write, either every time they pay themselves or once or quarterly, depending on how they're making their tax payments. They look at it as just a required retail payment. Like this is what my tax bracket is. This is how much I made. This is how much my tax bill is going to be. That's the problem. Most people don't realize that, particularly in the US, the first 5,000 or so pages of tax code really show you how to pay your tax. The remaining 70,000 plus pages show you different ways to pay less tax. So I look at that. The tax code is a huge coupon book. It's a very large book of coupons. Unfortunately, the IRS in the United States doesn't send a flyer out every week to say, oh, why don't you clip this coupon and clip that coupon so you can pay less tax. That's what I do. I help people find the coupons, which are specific tax codes that allow for you to implement certain things that give you tax benefit. So if you spend a little more time there, that 50%, 40%, 30% burden from your profit can be significantly reduced.
And what kind of reduction are we looking at? Are we talking about 5, 10% or more?
My average is generally 50%. I can usually reduce someone's tax burden by 50%.
Wow, that's a huge amount. That's a huge amount. And does it stop any range? So, for example, if I run multiple 7-figure companies, and one of them is verging on 8 figures now. So if I have, I'm also based in the UK, so it won't be relevant. So assuming I was based in the US and I had an 8-figure company, is there a threshold of how much we can save, or because after a certain amount you have those liabilities, or is it exponential?
Well, it's interesting because the more income someone has, the more opportunities there are. It's interesting, because a lot of opportunities have a cost.
Right.
So essentially, when you have to reduce your tax, there is an expense to that. So you have to make sure that your tax reduction is significantly more than your cost.
Right.
Just like business, right? I'm going to put my money into these cogs and I'm going to resell them for a profit. Same thing. If I'm going to do this strategy, if there's going to be cost to implementing this strategy, that is essentially but my net yield will be my tax savings. So if I can spend $1, but I can get $4 of tax savings, $4 of deductions, so to speak, well, that usually works out pretty well for people. If they can spend $1 and reduce their tax liability by $4, depending on their bracket, that can essentially help them. And that's, obviously there's a lot of different ways to do that, but that's the goal.
Okay. All right. So talk us through this now, this possible, how do we reduce that tax burden? So what are the few strategies that you can, share with us today?
Yeah, we'll start with some basics. I would say that at this point, my goal has been for the last decade is to seek out the different areas of the tax code that can be utilized for not only business efficiency, but also for tax efficiency as well. So I have over a dozen different ways to reduce taxes. And in most of the ways I'm working with other groups. So it's not like, again, remember, I'm a master's degree in sports management. I managed health clubs for a number of years. So I'm not like this tax attorney savant. I just know how to explore and find this group of tax attorneys that employ this strategy, this group of accounting professionals that employ this strategy, this group of business strategists that work with tax attorneys and CPAs to employ this strategy. And I know how to bring these groups into the play. Like, so I basically do an analysis, find facts. I say there's 4 coupons that you're not using that would work really well for you, Mr. or Mrs. Business Owner. Let's talk about how they work and let's talk about how to integrate them together. But one of the first things that I like to talk about, particularly in the US, is I call it the chip shot. Why do I call it the chip shot? It's because it was initiated, or it was born in this little place in Georgia called Augusta. And if you know golf in the United States, and you know that, oh, in Augusta, Georgia, every year there's this little tournament called the Masters. And it's a PGA tournament. It's very exclusive. The winner gets a green jacket. It's one of the biggest golf tournaments of the year. And interestingly enough, about 50 plus years ago, because it's such a small town, and the whole world essentially converges on it, at least the golf lover world from all over. They come to Augusta to enjoy the Masters, about a week or so event. And it's a very small town. So 50 plus years ago, the individuals that lived in very nice homes around this illustrious golf course, they realized that they could actually leave town, go on a little trip, and rent their home out to like a corporation coming in that wanted to wine and dine their clients and customers, and they wanted to have a nice space close to the course. So these individuals realized they could rent their homes and for a pretty penny and go away for a few days, whether they rent it to a very wealthy family, or they rent it to a corporation. So interestingly enough, what they did was they lobbied to Congress, the House and Senate, and they had friends in the House and Senate, and they said, hey, we have these homes that we're renting, but we don't get a lot of deductions for our personal rentals. We get a lot of deductions for our investment properties, but we don't get deductions for our personal homes. So the law was passed, and there's 2 tax codes, 163 and 280A. It basically says, and this is for anybody in America, by the way, you can rent your home, your personal home, which as long as it's not an income producing property, it's your primary residence, and you're not using it generally for income. You can rent that to a third party for up to a certain number of days per year, and the income that you receive from that third party to rent your home is not taxable. So the interesting thing about that is people are like, well, that's great, Mark, but I don't live near Augusta, the golf course, and I don't want strangers in my home. Why would I leave? And I don't want to Airbnb my own home just to get some free income. Well, I say, interestingly enough, if you own an S corp or a partnership or a C corporation, those are third parties. That's another person. So guess what that C corp, S corp, or partnership can do? 1065 partnership. They can rent your home for board of director meetings, business strategy meetings, any type of events that you want to have, or small meetings just to promote to grow your business. So now what you're doing is you're creating an expense through your corporation, but that expense is going straight to you as an individual, and you're not paying taxes on it. So you're reducing your profit from your company, and that profit's coming to you as a payment to rent your own home from your company. And those dollars that come to you, as long as you follow the rules, is not taxable. So I call it the chip shot because it's usually anywhere between $20,000 and $50,000 a year. Hey, but $20,000 to fit up to $50,000 a year that you're not paying taxes on, particularly in the high brackets in the US. I mean, that's could be $10,000 to $25,000 of tax savings
Yeah.
per year just for having meetings in your home and basically charging your corporation for those meetings and following the rules.
Wow. Yeah, that's amazing. I don't know if we have anything like that similar in London, in the UK at all. I'm rattling my brain about it at the moment, but I know that there are some. We've got some benefits when it comes to Airbnb, like short-term lets, and then we can let out a roomlet in our primary residence and make 7,500, which is tax-free as well. So something similar to that, but it's very small, but it's still there. But nothing in that capacity that you just mentioned. Okay, so that's one part. Can you give us any other strategy, another additional strategy which can help us reduce or make our tax into a profit center?
Absolutely. I mean, we could go on all day if you wanted to, Gull, but I'll keep you.
Let's share a few strategies. Let's share a number.
Sure.
Yeah.
I'll focus on some of the low-hanging fruit, and there's a couple more that I think are pretty with when it comes to income, regular income.
Mm-hmm.
So a lot of people understand that. And I don't know how this works in the UK, but in the US, when you give a donation to a charitable organization, qualified 501(c)(3), you can take a deduction for that.
Okay.
So, but the way it works in the US is, okay, I'm going to give to my church or my house of worship or a philanthropy that feeds needy, help people or helps single moms, whatever. When you give to them, you give them $1. And if your tax bracket, say your blended tax rate is 45%, which is like a California high income earner in California can be 45, 50 cents tax bracket. So they're giving $1 away, but they're saving, let's just call it 50 cents. Well, it still costs them 50 cents, right? They spend $1 to save 50 cents. The only way that that works is if you really love the charitable organization, well, then you got to give them $1. They got to keep the whole dollar, but it only cost you 50 cents. Okay, that's great for them, but it wasn't really an amazing, wealth building strategy for you. You just basically lost less money. So interestingly enough, and this would happen for 100+ years, people have been able to donate tangible assets. So now I say, well, what if you're not donating $1 to that charitable organization? What if you're donating an asset, a tangible asset that you own? Well, that becomes more interesting because when you donate an asset to a charitable organization, you can take the fair market value for the donation as long as you get a qualified third-party appraisal and it's done correctly. So the interesting thing now is I can give people an asset and I can for $1, but I can give them an asset for $1 that's worth, say, $4. So that becomes interesting. So now they control a $4 asset, but it only costs them $1. Well, now if you donate an asset that on the fair market value with the appraisal is worth $4, think about that in California tax brackets. $4 deduction gives them a $2 tax savings. It only costs them $1 to get a $2 tax savings. So they just traded $1 for $2 in tax savings.
I'm a bit lost.
100%.
I'm sorry. You can see that from my face. Why would you give something that's worth $4 for $1? I'm a bit lost. I mean, I know you're donating it, but if you're donating it. I don't understand the process behind it.
So that's an interesting question, Gull. I think that's where it becomes interesting, right? Who's going to, first of all, who's going to sell you an asset worth $4 for $1? Right? That's the first hurdle.
That'll be
okay.
So that'll be your business.
Right. The question I always get is, well, great, I'd love to buy an asset that's worth $4 for $1, but why would anybody in their right mind sell it if it's worth $4?
Yeah.
Well, a lot of times what we're doing in this situation is we're looking at commodities. We're looking at like things that people pull out of the ground. A lot of times it's minerals, trace minerals, certain types of things that they use for nutraceuticals or organic fertilizers. And now you have someone that maybe owns thousands of acres of this type of material, and it would take them 25, 30 years to sell through what they could pull out of the ground.
Okay.
So what we do is we go to them and say, hey, if you could sell a lot of that in a short period of time, right, you're still going to profit from it, but you're going to make a lot less when you sell it to us because we want to buy it at a bulk discount. How much would you be willing to sell at a significant discount to its current fair market value? And they wouldn't have been able to sell it anyway. So now they're saying, well, we normally sell it for this price, but we can only sell this much. And then, of course, we have to wait till next year to pull the rest out of the ground. And then we have to wait next year to pull the rest out of the ground. We say, okay, well, how much are you willing to pull out of the ground to make a much smaller profit? And if they're willing to pull it out of the ground, we'll say, we'll buy however much you'll give to us. So that's how we get the asset at a significant discount. And then we resell it in lots. So now we put it into a partnership. And we have a whole bunch of individuals that have high income, whether you're W-2, like you can be an employee or a business owner. And we say, Mr. or Mrs. Business Owner, Mr. or Mrs. High Income Earning W-2 employee, we can sell you an asset worth $4 for $1. And they say, well, great. How does that help me? Because I don't know. I don't understand how to sell this. I don't want to, I mean, I'm busy doing my work. I don't want to profit. Well, guess what? We already have a charitable organization. I would love to receive that asset and they can use it. So we say, purchase this asset in the partnership.
Okay.
Donate it to this charitable organization. It's an easy 1, 2, 3 process. And when they donate it, we say, well, guess what? A $4 deduction for you is going to give you $2 in tax savings. So we're basically giving you a $2 tax savings for $1. So that's essentially one of the coupons that we use, is to leverage their deduction. We're basically saying you can normally give money away to a charitable organization and get a deduction, but now that you're giving this tangible asset away, you can get a leveraged deduction because you can get I'm just using the $4 deduction. It only costs you $1 to buy a $4 deduction. Well, that's a significant gain once you get your tax savings. So the question is, how much can I do that for? You know, the federal limit in the US is 30%. If you have $1 million of income, you can't take a deduction for more than 30% of that. So $300,000, and that's the limit, right? Even though you might have $2 million worth of asset to give away, they're not going to let you take a deduction for more than 30% of your adjusted gross income. So we're always lining it up. We're saying, well, what are you making? Okay, well, let's just buy just enough asset.
You just said, Mark, that okay, so the max is 100 for 30% of a certain amount. So if it's $1 million, it'll be 300,000, and then
yes. So now that we know what the maximum deduction that someone can take is, we just backwards reverse engineer how much asset do they need to purchase to get that deduction. So for example, if someone has $1 million of income and we're trying to reduce that, so now we can reduce it by up to 30%. That's 300,000.
Yeah.
Now we can give that person a $300,000 deduction for $75,000 because we're able to give them access to this asset at a 75% discount to its current fair market value. So now that they purchased a $300,000 deduction for $75,000, if they're like a California resident in the highest tax brackets, they're going to save $150,000 in tax, but they only paid $75,000 to do it. So that's an interesting coupon, but it only works for 30% of your AGI. So then the people ask, well, what do I do with the remaining 70%? If you're $1 million income earner or $10 million income earner, and you're like, okay, you reduce my taxes by 30% or reduce my income by 30%, giving me a nice return, but I still have a lot of income to pay taxes on. What else can you do? And that's when we start working into multiple layers of strategy to we can't usually make their tax go away, but we can significantly reduce it.
Yeah.
Right.
That's what I'm understanding, that you can reduce it by a significant amount. And this is before, so this is on the business itself, not just personal income. It can be on the business amount, right? So I'm just asking questions because I'm trying to get my head around this. So in UK, we have businesses. So there's a corporation tax now, which has gone up from 19 to 25%, which is horrible, but it is. So we've got 25% corporation tax to pay. Once that's paid, if I take money from the business, it'll be dividends. So are we talking about that tax that can be reduced, or is it the corporation tax we're including as well that can be reduced?
Yeah, so this is a great question, Gull. In this coupon, we really focus on the personal income tax, because in the United States, your tax brackets on the personal side are higher than the corporate side, and
same here. Same for us as well. So if I'm above the 50,000 threshold, then I would be paying, once the 25% has been paid, then any money I take on top would be based on my tax, whichever bracket I fall into, and which obviously someone like me would fall in the higher bracket. So I end up paying about 40-50% tax, which is a lot, and that's so the corporation tax is separate, and then my personal tax is separate. That's what I was trying to get to it too. So this tax we're referring to is a personal element, right?
We want to tackle that high bracket on your personal side. Yeah. And that's where you get the leverage, because when you're getting, for example, on your corporate bracket is only 25, not only 25%, you're getting double tax, just like we do in the US with C Corps. But if you're buying an asset for 25 cents, that's worth $1. Well, if you take $1 deduction and you're at a 25-cent tax bracket, then you're right back where you started. Yeah. Right? You bought something for 25 cents, you get a $1 deduction, and of course you're at a 25-cent tax bracket, means you saved 25 cents in tax. So why did you even do it? You bought something for 25 cents, you gave it away, you got a 25-cent tax savings. So we want to do this at the personal level, because if you bought something for $1 or bought something for 25, let's use $1. You bought it for $1, it's worth $4, but your tax bracket is 50 cents, 45 cents. So now you're saving $1.70 or $1.80, but it only costs you $1. So that's where we really want to get that arbitrage is on the personal tax brackets because they're much higher and they much more effective.
I'm with
So
you.
that's an interesting way to do it.
Okay, I'm with you. So I think if you want to quickly just give a one or two others, just without the long explanation, just sort of just hint out to the others. Obviously, there are so many other things, and if someone's really interested, they have to contact you and sort of sit down with you with their personal situation, so you can guide them through. I just want you to hint out a few others, just briefly, before we wrap this episode up and sort of move forward, just so people get to understand that these are possibilities out there, and obviously they need to speak to an expert before, but rather than trying themselves, they can if you want to, but I'll highly always recommend going to an expert. So, but at least let them know that there are possibilities out there. So just give us a couple more.
So 2 more quick ones. Thank you so much for the opportunity. So one is, I'll give you Jeff Bezos. Most people know who Jeff Bezos is, right? Owner of Amazon. So Jeff Bezos purchased $30 billion worth of a certain asset last year. Not because maybe he does want to make the world a greener place, but he purchased solar to the tune of $30+ billion. Why did Jeff Bezos purchase solar? Why did Wells Fargo? Why did Chase Bank? Why did Bank of America? Why did they all purchase billions of dollars worth of solar last year? Well, because the federal government in the United States will give them a tax credit. So for every dollar of solar they purchase, they get, used to be 30%. Now you can get 40 or 50% of tax credit. And the tax credit is dollar for dollar. If you have $1 tax credit, then it offsets $1 of federal tax liability. What else do you get when you buy solar? You get depreciation because solar depreciates. What else do you get when you buy solar? Cash flow, because whoever is getting the energy from the panels has to pay for the energy. So Jeff Bezos, Wells Fargo, Chase Bank, they all purchased solar to the tune of billions of dollars last year because they wanted the tax credit, they wanted the depreciation, and they wanted the cash flow. I help people do the same thing, but they can actually get more benefit than Jeff Bezos. Why? Because his corporate tax rate is 21%. But we can take that depreciation against Gull, your personal income at 45%. So $1 depreciation is worth more to you than it is to Jeff Bezos.
Yeah.
So that's strategy number 2 is to buy solar, but doing it in a specific way where you get tax credit, depreciation, and cash flow, and you can take the tax credit and the depreciation against global income. Okay. So if you have income coming in from real estate, you have income coming from interest earning from these stocks, you have income coming in from your business or your W-2, we can actually take the tax credit and the depreciation from the solar and offset that income. Last but not least, there's so many more things that can be done. Again, that the book is huge, 70,000 plus pages. There's so many coupons in there. But the one that a lot of people like is when they're selling an appreciated asset. They've got this home, they've got this apartment complex, they've got this business, they've got this private equity. They helped their cousin in business, and now his business is worth a lot. And they're selling it, or they bought these stocks, and now they're worth so much more. And they're looking at this big capital gain. Right? They've owned them for a year or 2 or 3 or 4 or 5 or 20. Now they're selling and they're looking, oh, I've got to pay in California as high as 37%, capital gain, after federal plus NIIT plus the state. And then even in Florida, is 23.8%. So how do we make that 23.8 to 37% tax go away? And that's all about structuring your sale. So prior to selling that asset, we need to actually shift the assignment of income away from the owner. So if we can pre-plan that sale and make sure we move the ownership into a different entity that you control, but you own tax in this entity for the tax, but there's a lot of different ways for that new entity to pay that tax bill, which are significantly better than you paying the tax bill if you just sold it in your name. So I guess where I'm going here is prior to selling an asset that you're going to pay a significant amount of capital gains tax, let's talk about how we can structure that sale to give you a lot better tax outcome as long as you don't sell it in your name.
So that was really insightful and very, very interesting. But now let's just wrap this up, today's episode. So tell us, Mark, how can we connect with you? Because I do believe that these are great insights, but if you want to really if you want to really benefit from this, you need to speak to an expert or mentor like yourself. Doing it on your own, you'll like to fall in the pitfalls. So how would someone connect with you in the US and sort of seek your help?
Just come to my website, peakprofitsolutions.com. And on that website, they'll be able to learn a little bit more about me. They can actually schedule an appointment. I have a calendar available where I can take, a 20-minute conversation. And literally, it only takes me 20 minutes or so to determine how much opportunity or how many coupons the person is eligible for. So go to peakprofitsolutions.com and find a time to chat, or maybe just download some case studies and we can get started from there.
Wonderful. Now, if you are listening to our podcast, the link for Mark would be in the show notes. And if you're watching on YouTube, down below in the description section, we'll have all the link for Mark Myers as well. Do check him out. And especially if you're in the US, check him out, see how he can help you reduce your tax burden and make it into a profit center. Well, thank you so much for joining us, Mark. It's been a wonderful experience. And even though you're specifically, talking about US tax laws, I think I've got some ideas about what was possible for us in the UK too. So thank you so much for today's episode.
Thank you so much for having me. It was a lot of fun.
And thank you for listening to me and Mark today on Money Talkies. I will be back with another amazing guest, finding out how you and I can build a better business. Until the next time, this is Gull signing off. Take care and bye for now.